Greetings, ladies and gentlemen. My name is Rick Rule, and I am speaking to you from sunny Carlsbad, California. For those of you who don't know me, I've been investing in natural resources and precious metals for about 45 years. I'm employed by Sprott Inc., which is a Canadian domiciled U.S. listed investment manager in natural resources and precious metals. We manage or administer about 17 billion US dollars on behalf of 200,000 customers and shareholders worldwide. I'm delighted, by the way, to have a chance to address a European audience, and those of you who are Sprott customers or Sprott shareholders in Europe, a special warm greeting from myself to you. It's important to note at the beginning of a discussion of precious metals and natural resources markets that these markets are particularly cyclical, particularly capital intensive, which assists in their cyclicality, and also particularly volatile. I would go so far as to say that to be a long-term investor in precious metals and natural resources, that you must be a contrarian or you will be a victim. The truth is, in our business, in the resource business, in the precious metals business, bear markets are the very authors of bull markets. They're the cause of bull markets. And conversely, bull markets themselves are the cause of bear markets. And the remarks that I intend to give in the rest of my visit with you will effectively just address this overlying premise. And I think for all of us, that's very good news. If bear markets are the authors of bull markets, given the bear market that we have just been through, which depending on how you count, began in 2011 and extended through 2019, was certainly a bear market for the record books. Many commodities experienced 75 or 80% price declines. And the most popular small cap resource index, the Toronto Stock Exchange Venture Resource Index, fell a stunning 88% in nominal terms and more, in fact, in real terms. If it is true, as I have observed, that bear markets are the authors of bull markets, the bear market that we have been through sets the stage, I think, for a really, truly remarkable recovery. In fact, I would suggest to you, and I will argue for the rest of my visit, that we are in for not one, but two very good bull markets, one of which is underway. Specifically, I think we are in the early or mid stages of a very good bull market in precious metals and precious metals equities, which I'll talk about first. And I think that that will be followed by a surprise bull market, but an equally attractive bull market in industrial materials, base metals, and the stuff of man, those type of commodities. And I'll tell you why I think that those will be different bull markets, but both attractive bull markets later on in this visit. Notice too, in this visit, that I will describe two stock charts. One, the Behrens Gold Mining Index stock chart, not because I'm a technical analyst, but rather because it's the best visual tool I know of to describe where we are in this market relative to earlier markets, and also to talk about the anatomy of a precious metals equities bull market and how to play the game over time. The second chart, which I will refer to much more briefly, is a 100-year commodity chart. And at the end of this discussion, I'll give you a web link where you can obtain both of these charts for your own reference. I highly encourage you to do so, because I think they're really instructive in terms of, as I say, the anatomy of bull markets and how to play them. So let's get started. Those of you who are precious metals investors are doubtlessly pleased with the way the market has played out in the last 18 months, both in bullion and the equities, or for many of you, one of the others, for others of you, both. And I think this continues. In my own experience, gold bull markets, and this will be borne out by the chart when you see it, gold bull markets are dramatic, both in terms of duration, which is to say they last a long time, and also in terms of dimension. It is useful to recognize at the beginning of the discussion that there are two types of moves in the gold equity indexes. One being recoveries from oversold bottoms. We have had 9 of these over 45 years, and they can occur in secular bull markets or secular bear markets. And while they're dramatic in terms of dimension, they're seldom dramatic in terms of duration, which is to say they don't cover long periods of time. Bull markets are very different. The first bull market of my career commenced in 1970 and ended in 1981, and saw the gold price go from $35 an ounce US to a high of $850 an ounce US. Interestingly, the equity indexes outpaced the metal itself, although the metal enjoyed a 30-fold gain. The second bull market began, depending on how you count, in the year 2000 and ends again, depending on how you measure, in 2011. And this was a dramatic bull market too, although not in relation to the first. The gold price advanced from about $250 an ounce US to $1,900 an ounce US in the 11-year time frames. So when people say to me, Rick, have I missed the boat? This bull market is already 18 months old, and the gold price is already up by 40%. Have I missed the mark? I would suggest to you that if past this prologue, given the prior bull markets that I've enjoyed in my career, that either in terms of duration or dimension, this bull market is still has a long way to run. We can say that simply by looking at prior bull markets, but in order to have the courage to stay the trade, we have to know why. We have to do more than look. And this is instructive too. I'd like to run through the why of this gold bull market before we move on. I've learned in my life that gold bull markets are particularly dramatic because they appeal to both primary investment motivations, which is to say fear and greed. Most investments appeal to one emotion or the other, an insurance style investment or a momentum style investment, but gold appeals to both. The fear trade in gold always leads off the market. The momentum that gets established in the fear trade leads to the greed trade. But the interesting thing is that the market ricochets from one to the other, does so for a long time, and it does so to substantial dimension. So let's talk about what people might be afraid of and why this gold bull market may be taking place. Note too that I'm speaking from a US-centric point of view, which while it can be directly related to the European circumstance, is different in some fundamental regards. It is my belief that gold responds to many types of fear. Fear of political circumstance, fear of economic circumstance, fear of social circumstance, but that the most important determinant of the perception of gold has to do with fear of the deterioration of the purchasing power of savings instruments or investment instruments denominated in fiat reserve currencies. It is not a US-centric remark to suggest that the world's reserve currency at present is the US dollar. And I would argue with you, perhaps, that the most important determinant of the gold price is faith in the purchasing power of what is really the world's current benchmark security, which is the US 10-year Treasury. And I would suggest that it's nervousness about the purchasing power, ongoing purchasing power of money stored in US 10-year Treasuries and related savings instruments that is primarily driving the gold price. Let's look at the 5 factors that I see driving this market. The first, irrespective of what country you live in, almost irrespective of what developed nation you live in, is quantitative easing. Central banks and governments around the world are creating currency units. They're adding liquidity to the system. Whether you believe this is good economic policy or bad economic policy, you cannot argue that adding artificial liquidity to the system debases the currency. This is a simple fact. If you make more of something, arguably, if you make more of a currency at a time when the economy is shrinking, the artificial nature of the debasement is in fact greater than it would otherwise be the case. But certainly governments and central banks around the world are adding more and more and more currency units in the face of soft economies, and therefore almost by definition debasing their currencies, be it dollars, yen, yuan, or euros. The second thing that reduces confidence in fiat currencies are central government debt and deficits. I don't know the appropriate European numbers, so I won't bore you with them. But I'm very familiar with the US numbers because I live here. The on-balance sheet liabilities of the US federal government, before state and local bond liabilities, exceed $27 trillion. This is an astonishing amount of money. But it gets worse. The net present value of entitlements in the United States, which is to say things like Social Security, Medicare, Medicaid, social programs, and other programs, is estimated by the US Congressional Budget Office to exceed $150 trillion. When you add the 150 trillion to the 27 trillion, you get a truly stupendous number. Such a large number that the perma-bull on the United States, Warren Buffett, says it will never be paid off. It will only be rescheduled, refinanced, and run off. And the nature of a $187 trillion liability that needs to be serviced and paid for by the national income is highly problematic, because the national income at the federal level in the United States, that is to say taxes and fees on the income side, minus expenses on the liability side, is in deficit. In fact, the deficit this year will exceed $3 trillion. And in the month of July alone, the US federal government deficit exceeded $850 billion. As I say, this is before state and local debts and also before unfunded or underfunded pension plans. It's very clear that the debt and the deficit of its own nature has to decrease confidence in the purchasing power of the US dollar, given that it can't be repaid. It can only be extended or defaulted upon. The third, and in my view, most important factor, fear factor or competitive factor, is negative real interest rates. Buffett, again, says negative real interest rates are not a force of nature. They're a construct of man. They're governments trying to be bigger than markets. Let's examine what interest is. Interest is the payment that savers receive for foregoing consumption in favor of other people who want or need to consume now. Interest is also recognition of the time value of money and recognition in the risk inherent of being a lender to any debtor in any circumstance. And the idea that savers would put up their savings to receive back less than they had lent is a truly strange phenomenon. Again, in the context of the US 10-year Treasury. The US 10-year Treasury, which is to say debt obligations, or to say another way, confidence in the US dollar, has been in a bull market for 38 years, a bull market which is long of tooth by anyone's standards. Arithmetically, at the beginning of that bull market, the US 10-year Treasury yielded, if my memory serves me well, about 15.5%. Currently, it yields about 60 basis points. Given that yields vary inversely with the capitalized value of the yields, the truth is that we've been through a long and spectacular bull market in both the dollar and the US 10-year Treasury, but a bull market that arithmetically at least is either over or almost over. Here's why. A 60 basis point yield in a currency that the Congressional Budget Office themselves acknowledges is losing value at the rate of 1.6% a year means that if you loan money to the US government over 10 years, you lose 1% a year in purchasing power. This may be the first promise that the US government has ever made to me that's going to be true. If I give them money now, they'll give me back less 10 years from now. than I gave them. My friend Jim Grant describes these government debt securities as, quote, return-free risk. So I would argue with you that gold's principal competitor for investors' attention is an investment that offers return-free risk, a fight I believe that gold can win. The fourth factor related to all of the others is that precious metals and precious metals related equities, at least in the US market, and I suggest in Europe too, are under-owned relative to historic standards, despite the fact that the circumstances are in place to make them attractive. In the US, the appropriate number is that the market share of precious metals and precious metals related investments is less than 0.5% of total savings and investment products in the United States. The 3-decade mean, as I understand it, is somewhere between 1.5% and 2%. So I'm not suggesting that the US government defaults on its obligations, that the US dollar goes to zero, that we go back to a gold standard, any of the things that some of my peers suggest. All I'm suggesting is that as a consequence of the challenge that the US dollar faces, that the market share of precious metals and precious metals related investments reverts to the 3-decade mean, which is between 1.5% and 2%. If that happens, investment demand for precious metals and precious metals related assets in the largest savings and investment market in the world goes up between 300% and 400%. And that's something that I actually believe is going to occur. The fifth factor is very interesting to me. I was introduced to this by my partner at Sprott, John Hathaway, the legendary gold equities manager who manages our mutual fund business. John pointed out to me that institutional investors around the world manage around $100 trillion. And traditionally, institutional investors have had a investment matrix that was approximately 60% equities, 40% debt. But this, Mr. Hathaway suggests, is going to change, again, because of negative real interest rates. Before, the idea was that as the economy slowed and share prices fell, that the interest rate fell, and the capitalized value of that interest rates in bonds rose, so that bond bull markets would act conversely to equities bull markets. And while you waited, you had a positive yield from the bonds to overcome the time value of money, a real yield. But negative real yields means that the hedge that you have in terms of bonds costs you money every quarter. And Mr. Hathaway believes, I think for good reason, that there will be disintermediation, which is to say selling of these debt portfolios, and that some of that money will find its way into gold. $40 trillion? No, of course not. Some fraction of that. But a large enough fraction relative to the demand that we've seen in the gold market for the last 30 or so years to have a fairly dramatic impact on price. So for those reasons, quantitative easing, debt and deficits, negative real interest rates, the fact that gold is under-owned, and also the necessity for institutional investors to diversify out of some of their bond holdings, I think that the precious metals price continues to go higher. And the consequence of that is that I see precious metals equities prices going higher too. A couple observations there. In the past 2 bull markets in my life, they began very much the way this one did, which is to say the gold price moved first. And it took 6 to 9 months of higher gold prices for the gold equities to move higher. What happened was that the increase in gold price, the increase in the selling price of the product of gold mining companies went up faster than the cost associated with producing it. And so producer cash flows increased. This is first seen in the income statement, it's later seen in the balance statement. But what's important in moving equities markets is that equities markets, the sector outperforms expectation. And here too, the bear market was useful because the expectations were extraordinarily low. It wasn't difficult to exceed them because there were none. But the truth is that the gold mining industry in the last 18 months has demonstrated truly spectacular financial performance, which, as I say, showed up first in the balance sheet, in the income statement, is now showing up in the balance sheet. Every prior gold bull market began this way, and every prior gold bull market began with the best equities moving first. The companies that had the best balance sheets, the companies that had the best operating margins, the companies that had the best assets, and the companies that had the best management teams would move first. In prior bull markets, what I call the best of the rest, which is to say the second tier majors, would move next. Then the single asset companies, which were perceived rightly as being more risky because they only had one source of income, would move. Then the property developers, then the advanced explorers, then the explorers. In this particular bull market, something interesting has happened, I suspect as a consequence of social media and narrative. The best of the best certainly moved first and moved far, moved well. But then the gold bull market went all the way through the value chain without skipping a beat and went to the ultra speculative juniors. I'm not sure why this has happened, but it's left a valuation gap in the middle. Normally, when the juniors move, it's the end of a bull market. But in this case, the juniors moved without the best of the rest, without the single asset takeover targets, without the advanced exploration or development companies moving, which has left a valuation gap in the middle, which is one of the reasons also why I believe that this market has further to go. It's also useful in describing precious metals markets and precious metals equity markets to look at a couple other truisms from history. The first is that even during a secular bull market of 10-year duration, there can be cyclical perturbations, which is to say volatility, that are unnerving. The gold equity indexes can fall by 15% or rise by 15% with the same ease that you and I inhale and exhale. And until you get used to this, it can be extraordinarily unnerving. The volatility in the sector is just something that you have to get used to. Of course, if you have belief in the narrative, if you have belief in the premise, if you understand the companies in your portfolio, this volatility can be very useful. Just as I said earlier, that bear markets are in effect sales, long, deep sales. Cyclical declines can also be short-term sales, and sales are, of course, good. If you have a sense of something, if you have a sense of what your company is worth, then you have a sense of whether it is overpriced or underpriced during these periods of cyclical volatility. If you regard volatility as a series of sales, you will begin to understand how to play at least the first half or 2/3 of a gold bull market. Another observation for you over 10 years is that gold moves first and then silver follows. We began to see a dramatic recovery in the silver price in the last 4 months. Silver seems to have stalled out. If past is prologue, gold will lead again. But when silver moves, traditionally, it moves further and it moves faster. The second is, of course, that the precious metals move and then the precious metals equities move after that. The silver equities generally moving last of all, but that hasn't happened this time. The narrative associated with silver mining equities meant at least the small, highly speculative ones moved very, very, very fast. It is my belief that people will be able to continue to play both the precious metals and the precious metals equities as long as the underlying drivers are in force. And I think this is a very interesting circumstance. If you see the end to quantitative easing worldwide, but particularly in the EU and in the United States, you'll need to become concerned about the gold bull market. If you see debt and deficits decline dramatically, in the US context, if you see the US federal deficit below 1% of GDP on an annual basis, you will begin to see fiscal discipline return to the US. I'm not saying you're going to see that, but that would be the statistical marker that you would look at. Finally, with regards to at least US Treasury securities, if you saw a positive yield, a real yield of 250 basis points or better, that is, if the US 10-year Treasury was yielding 250 basis points above the underlying rate of inflation, you would start to see movement out of gold back into U.S. treasuries or euro-denominated treasuries or other fiat-denominated treasury securities. I don't see in the next 2 or 3 or 4 years any chance of that happening in any developed countries. But if I did begin to see that style of fiscal discipline, I think you would see a dramatic strengthening of the currencies, perhaps a weakening of the economy like you saw in 1982. And I think it would be very difficult to see in the gold bull market. But for those of you who believe, like me, that the next 2 or 3 or 4 years will see continued fiscal measure, continued quantitative easing, continued debt and deficits, and continued negative real interest rates, I think you'll see a continuation of a precious metals equity bull market. I know that many of you have enjoyed it so far. I certainly have. My suspicion is that you have at least 2 or 3 good years coming to you. I think the surprise, however, will be the second bull market, which is the bull market in what I call industrial materials and other commodities. While it is true that the broad commodities market and the energy market, for that matter, is very cheap in a historic context, my suspicion is in the near term, it will get cheaper still. I need to acknowledge I believed that for 6 months, and thus far, at least with regards to iron ore, coal, and copper, I've been very wrong. That notwithstanding, hear my thesis, please. My belief is that we will have a fairly soft economy on a global basis, worldwide, efforts of central banks notwithstanding. I believe this for at least 3 reasons. The first is that we had a 10-year recovery from 2009 to 2019 as a consequence, I think, of fiscal stimulation, artificially low interest rates around the world. And in my experience, 45 years of investing, a 10-year economic recovery is one that's very long of tooth. The idea that you could have a 10-year expansion without having a recession at the end of it is sort of unheralded in my investment career. So of its own volition, I suspect that the economic expansion that the world has seen was ready for a recession. And we got a wonderful, wonderful, wonderful trigger, a wonderful catalyst in the form of the COVID-19 virus. The economic devastation done by the COVID-19 virus and the restrictions on travel and trade was dramatic. And I don't think these have been factored into the market yet. My suspicion is that the relative strength in the economy compared to what would have been expected given the costs that the economy faced have been muted again by artificially low interest rates and stimulus. The third is the rise of economic nationalism around the world. Trade restrictions, investment restrictions. Restrictions such as this make everyone poorer. That isn't to say there aren't some winners, some politically connected winners, but the truth is that restrictions on freedom make everyone in the world poorer. So my own belief is that the next 2 or 3 or 4 years is going to be relatively soft in terms of the global economy. A relatively soft global economy means that you're going to have relatively soft demand for industrial materials. Wouldn't surprise me to see the iron ore price go down. Wouldn't surprise me to see the copper price go down. Wouldn't surprise me to see the oil and gas price go down. But this bear market in materials will be the author, I think, of a bull market that resembles the bull market in materials that we enjoyed in the 2000 to 2006 period. Let me explain to you why. Natural resource-based businesses, extractive industries, are extraordinarily capital intensive and extraordinarily cyclical. We have already, as a society, underinvested in productive capacity in extractive industries going all the way back to 2012, which is to say the industry hasn't made sustaining capital investments and they haven't made new project investments. And the consequence of that is that the productive capacity in these industries is falling. That's an interesting circumstance because when you balance supply and demand by reducing supply, given the extraordinary amount of money and the long lead times that are required to increase supply, When the market tightens up and commodity prices begin to move higher as a consequence of scarcity, the industry can't produce more material to take advantage of the price signal. And you get the price spikes that you saw in the 2000 to 2006 period. I think this is going to happen. We already have many natural resource commodities that are in deficit in terms of production. We're living off past stockpiles. And if we continue to constrain investments in sustaining capital and in new project capital, these production capabilities will decline further. And it'll take place, I think, in some areas that really, really surprise you. One will be oil and gas, I think, despite the widely held premise that all of us are going to be driving $150,000 Teslas and that the age of oil and gas is behind us. That's actually really completely silly. The International Energy Agency suggests that the year when peak demand for oil and gas is likely to occur is 2035, a long time from 2020 or 2021. It has been estimated that in US dollar terms, the fully loaded cost to produce a barrel of oil is between $50 and $60 a barrel US. So at present, the industry makes the stuff. This, by the way, includes cost of capital, exploration, prior year write-downs, taxes, indirect expenses, not just lifting costs, the total cost. So you make the stuff for 50 bucks a barrel, you sell it for 40 bucks a barrel, you lose 10 bucks a barrel, and you do it 90 million times a day. This gets beyond boring all the way to terrifying. And the consequence of that is that you reduce sustaining capital investments, you reduce your ability to produce, and when supply and demand balance as a consequence of reduced supply, the price can soar, and I believe the price will soar. I'm using oil not to focus on oil, but rather to explain how this works. Test my thesis on your own psyche. Those of you who drive gasoline or diesel-powered vehicles in Europe, do you believe in 2025 that when you leave your bedroom and go to your garage and turn the key to the right, that the car will start? If you believe that the car will start, in other words, if you believe that you'll have ample supplies of gasoline or diesel 4 years from now or 5 years from now, then you believe that the industry will at least earn its cost of capital, and that the oil price in US dollar terms will go from below $40 a barrel probably to above $60 a barrel. No one on the face of it believes in oil and gas. No one on the face of it believes in nuclear. No one on the face of it believes in coal. But the truth is, these are all important commodities for the way we live. And they will return to the cost of production. Why? Demographics, for one thing. There's 7.7 billion of us on Earth. The bottom 2 billion in the last 30 years have become really rapidly richer. It doesn't mean that they're rich. It doesn't mean they aren't desperately poor. But the truth is that their living standards over the last 30 years have increased dramatically. And they all want to live the way that you and I live. And that requires resources. When people in the West get more money, they spend it on services, or they spend it on technology. They spend it on little gizmos from Apple that don't require very much by way of material input. But when poor people get more money, they want to be electrified. Many people don't realize that 1 billion people on Earth still don't have access to basic electricity. They all want it. They're all going to have it. And this will lead to incredible increases in demand for things that transmit, store, and utilize electricity. People increase their calorie counts, which leads to increased demand for food products and the minerals necessary to produce food products, and a whole range of commodity-intensive consumer goods. Perhaps in Malawi, a villager replaces his or her thatch roof with a steel roof. Perhaps their method of transportation goes from barefoot to shoes, to a bicycle, to a 50cc motorcycle, to a Toyota Hilux pickup truck. You get the point. The ascent of man and increase in population means that over time, commodity prices need to go up to the cost of production, or the way we live changes. And I believe that that's going to occur sometime in the next 5 years. And I believe that the increases will be as dramatic as they were in the 2000 to 2006 timeframe. My suspicion is that we have a soft period in industrial materials first, a 2-year or 3-year period that will try your patience, but will in fact give you opportunity. So my thesis is still that you all will enjoy 2 bull markets, a precious metals bull market and an industrial materials bull market. And these bull markets will act in fairly predictable fashion. The beta, that is the return on the equity indexes, will be long and dramatic, meaning that most people don't necessarily even need to speculate too much to outperform the index. Participating in the index is good enough. If, as an example, you like my thesis with regards to industrial materials and don't want to wait 2 years or 3 years for fear of missing it, buy the biggest, buy the best, and buy the ones for good dividends, so that the wait doesn't burden your portfolio with the time value of money. These dividends can be a wonderful way to make you more patient for the ultimate bull market. Don't be afraid to concentrate your portfolios both in precious metals and in other natural resources, as to say 75%, with the biggest and the best and the finest companies. Don't always try to outperform the index, because the indexes themselves in bull markets perform spectacularly. I'm not saying not to speculate either. All of the money that I now invest wisely and conservatively, I made by speculating wildly. I dearly love speculation, and I suspect it's why you're listening to this particular channel. There are predictable themes in speculation, which perhaps your host will allow me to share with you on another broadcast. But the truth is, the more you understand about the market, the more you understand about your investments and speculations, the better you will in fact do. And I'm going to give you an incentive to learn how to do that. Now, I have enjoyed visiting with you, and I would like to visit with all of you, every one of you who has an interest at length in the future. As an inducement to that, I'm going to suggest on a no obligations basis that you visit a website, SprottUSA.com, SPROTTUSA.com/rankings. When you go to that site, you'll see a web form. If you enter your natural resource equities portfolio on that web form, names and symbols, I personally will rank your natural resource holdings. This is not investment advice. It doesn't suggest that they're all good stocks for you. I'm just ranking the companies on a 1 to 10 basis, 1 being best, 10 being worst. In addition, I will comment on individual issues if I think that my comments have any value. Finally, I will send to anybody who requests this ranking copies of both the Behrens Gold Mining Index stock chart, which is a wonderful illustrative tool to see where we are in this bull market relative to earlier bull markets, and also the 100-year commodity chart, which will show us just how cheap commodities are relative to their place in the economy over the last 100 years. And will also show you both the cyclicality and the volatility that commodities markets have exhibited over time. I would like to thank so much the sponsors of this video for giving me the opportunity to visit with our European audience and hopefully to expand our European audience. I hope that you're enjoying the gold bull market that you're in the midst of, and I hope you enjoy the ensuing commodities bull market even more. Ladies and gentlemen, it has been an absolute pleasure to visit with you. I hope to visit with more of you soon. So please visit the website. Please avail yourself of my rankings offer, and please study the 2 charts that I sent you, not in the context of technical analysis but rather as illustrative tools about the assertions that I've made in terms of the bull markets, the anatomies of bull markets, and the fact that bear markets are the authors of bull markets. Once again, it's been a delight talking to you. Great investing, and please stay safe. Thank you. Bye-bye.